If you're living in the United States as a green card holder, naturalized citizen, or even a US-born citizen with financial ties abroad, there's a critical tax reporting requirement that millions of people don't know about. And failing to comply can result in penalties of up to $10,000 or more per year. I'm talking about foreign account reporting, specifically FBR and Form 8938, rules that have been in effect for years but remain widely misunderstood. Whether you have a small savings account in your home country, inherited property overseas, or receive a pension from another nation, these rules might apply to you right now. The problem is, most people only find out about these requirements when they receive a notice from the IRS or when their citizenship application gets delayed. But here's the good news. Once you understand these rules, compliance is actually straightforward. Stay with me for the next few minutes because I'm going to explain exactly what these requirements are, who they affect, and the simple steps you need to take to stay fully compliant and avoid unnecessary penalties. Hello, and welcome back to Move to USA. I'm here to help you navigate the complex world of US immigration and tax requirements with clear, accurate information you can actually use. I know that dealing with IRS rules and immigration paperwork can feel overwhelming, especially when you're trying to build a life in a new country or manage finances across borders. The truth is, the US tax system has unique requirements that don't exist in most other countries, and many immigrants, green card holders, and even longtime residents simply don't know about them until it's too late. Today, we're diving deep into one of the most misunderstood areas of US tax law, foreign financial account reporting. This isn't about some future rule change or new legislation. These are requirements that exist right now, today, and have been in place for years. Yet countless people remain completely unaware of their obligations. My goal is to give you a complete, accurate picture of what you need to know so you can file correctly, avoid penalties, and if you're pursuing citizenship, ensure your tax compliance doesn't create problems for your immigration case. Before we get started, if you find this information valuable, please hit that like button and subscribe to Move to USA so you never miss important information that could affect your life in the United States. And don't forget to click the bell icon so you're notified whenever I post new content. Now, let's break this down step by step in a way that actually makes sense. Understanding US worldwide income reporting. First, let's establish a fundamental principle of US tax law that surprises many people. The United States taxes its citizens and residents on their worldwide income, regardless of where that income is earned. This is different from most countries, which only tax income earned within their borders. What this means in practical terms is that if you're a US citizen, green card holder, or meet the substantial presence test as a resident for tax purposes, you must report all income from all sources, including foreign bank accounts, foreign investments, foreign pensions, rental income from overseas property, and any other financial interest you have outside the United States. This doesn't necessarily mean you'll pay double tax on everything. The US has tax treaties with many countries that help prevent double taxation, and there are credits and exclusions available. But the key point is this: you must report these foreign financial interests even if you don't owe additional US tax on them. Many people make the mistake of thinking that because they already paid tax in another country, or because an account has very little money in it, they don't need to tell the IRS about it. That assumption can lead to serious problems. What is FBR, the Foreign Bank Account Report? Let's start with FBR, which stands for Foreign Bank Account Report. This is officially called FinInCEN Form 114, and it's filed with the Financial Crimes Enforcement Network, not directly with the IRS, although the IRS enforces compliance. The FBR requirement has been around since 1970, though enforcement has become much stricter in recent years. Here's how it works. You must file an FBAR if the aggregate or total value of all your foreign financial accounts exceeded $10,000 at any time during the calendar year. Notice I said at any time, not just at the end of the year. If your combined foreign accounts reached $10,000 even for a single day, you have an FBAR filing requirement. And when I say combined, I mean you add up all accounts together. You can't look at each account individually and say, well, this one only has $3,000 and that one has $5,000, so I'm under the limit. No, You add them all together. If the total ever exceeded $10,000, you need to file. What counts as a foreign financial account? This includes bank accounts, brokerage accounts, mutual funds, and certain other types of financial accounts maintained with a financial institution physically located outside the United States. It also includes accounts where you have signature authority, even if the money isn't yours. For example, if you're an authorized signer on your elderly parent's account overseas, that counts toward your FBR threshold. The FBAR is filed electronically through the FINAN BSAE filing system, and the deadline is April 15th each year with an automatic extension to October 15th. You don't request this extension, it's automatic. Importantly, the FBAR is separate from your tax return. You don't file it with your Form 1040. It's a completely separate filing requirement. What is Form 8938? Statement of Specified Foreign Financial Assets. Now, let's talk about Form 8938. This form was introduced in 2011 as part of the Foreign Account Tax Compliance Act, known as FATCA. While FBAR and Form 8938 both deal with foreign accounts, they're different forms with different requirements, different thresholds, and different filing procedures. Form 8938 is filed with your tax return as an attachment to Form 1040. The thresholds are higher than FBAR, but they depend on your filing status and whether you live in the United States or abroad. For unmarried taxpayers living in the United States, you must file Form 8938 if the total value of your specified foreign financial assets is more than $50,000 on the last day of the tax year or more than $75,000 at any time during the year. For married taxpayers filing jointly and living in the United States, the thresholds are $100,000 on the last day of the year or $150,000 at any time during the year. If you live abroad, the thresholds are significantly higher. $200,000 on the last day of the year or $300,000 at any time during the year for single filers and $400,000 or $600,000 respectively for married filing jointly. Form 8938 covers a broader range of assets than FBAR. In addition to foreign bank and brokerage accounts, it includes foreign stocks and securities not held in a financial account, interests in foreign partnerships, foreign trusts, and certain foreign pensions or deferred compensation plans. This means you could be below the FBAR threshold, but still need to file Form 8938 or vice versa. In many cases, people need to file both. Who needs to worry about these requirements? These requirements apply to several categories of people. Obviously, U.S. citizens who have lived, worked, or maintained financial relationships abroad need to be aware. This includes Americans who worked overseas for part of their career and kept retirement accounts or bank accounts in those countries. Green card holders are U.S. tax residents and must comply with all the same tax rules as citizens, including foreign account reporting. Many green card holders maintain accounts in their country of origin, perhaps to support family members, handle property matters, or simply because they haven't fully transitioned their financial life to the United States. These accounts must be reported. People who meet the substantial presence test for tax residency also have these obligations. You meet this test if you were physically present in the U.S. for at least 31 days during the current year and 183 days during a 3-year period that includes the current year and the 2 preceding years using a weighted calculation. Many people on work visas or other long-term statuses meet this test and become U.S. tax residents. Even though they're not citizens or green card holders, naturalized citizens who still maintain financial relationships in their birth country need to understand that becoming a U.S. citizen doesn't exempt them from these reporting requirements. Your U.S. citizenship makes you subject to worldwide income reporting for life, regardless of where you live or where your money is located. Even U.S.-born citizens who inherited foreign accounts, married someone from another country, and opened joint accounts overseas, or worked internationally and maintained banking relationships abroad need to comply with these rules. Common scenarios where people have reporting obligations. Let me give you some real-world examples to make this concrete. Imagine you're from India and you came to the United States on an H-1B visa 10 years ago. You eventually got your green card and are now applying for citizenship. Back in India, you still have a savings account you opened when you were in college. It has about 800,000 rupees in it, which is roughly $10,000. You rarely use it, but you keep it open in case you need it when visiting family. This account must be reported on FBAR every single year if it exceeds $10,000 in combined value with any other foreign accounts you have. Failure to report it could complicate your citizenship application. Or consider this. You're a naturalized U.S. citizen originally from Mexico. When your mother passed away 5 years ago, you inherited a small piece of property in Guadalajara along with your siblings. The property generates a small amount of rental income, and that money sits in a Mexican bank account under your name. Even though you're sharing this property with family members and the rental income is modest, both the bank account and the income must be reported on your U.S. tax return. If the account balance exceeds the thresholds, you need to file FBAR and possibly Form 8938. Here's another common situation. You're a Filipino American who sends money regularly to family back home. To make this easier, you opened a bank account in the Philippines where you transfer funds and your family members can withdraw as needed. The account is in your name, and throughout the year, the balance fluctuates between $5,000 and $15,000, depending on when you make transfers and when family withdraws money. Because the account exceeded $10,000 at some point during the year, you have an FBAR filing requirement, even though the money is really meant for your family's use. Or think about someone from the UK who became a US citizen but still has a pension from years of working in London before immigrating. That foreign pension might need to be reported on Form 8938, depending on its value, and any distributions from it must be reported as income on your US tax return. What if you've already made mistakes? If you're listening to this and realizing you should have been filing FBR or Form 8938 but haven't been, don't panic, but also don't ignore the situation. The IRS offers several programs designed to help people come into compliance, particularly when the non-compliance was unintentional. The most relevant for most people are the streamlined filing compliance procedures. These procedures are designed for taxpayers whose failure to report foreign financial assets and pay all tax due was non-willful. If you qualify, you can file amended tax returns for the past 3 years, file FBARs for the past 6 years, and pay any tax due plus interest, but with significantly reduced penalties compared to what you'd face otherwise. For U.S. residents, there's a 5% penalty on the highest aggregate account balance during the years in question. For taxpayers residing outside the U.S., there's no penalty at all under the streamlined procedures. The key to qualifying is demonstrating that your failure to comply was non-willful. This generally means you didn't know about the requirements, perhaps because you were unaware of U.S. tax obligations regarding foreign accounts or you misunderstood the rules. If you knew about the requirements and deliberately chose not to comply, the streamlined procedures aren't available and you'd face much more serious consequences. Another option for certain taxpayers is the delinquent FBAR submission procedures or the delinquent international information return submission procedures. These allow you to file late FBARs or Forms 8938 with a reasonable cause statement if you don't owe any additional tax and meet certain other conditions. The absolute worst thing you can do is continue ignoring the problem. The IRS is increasingly sophisticated in identifying foreign accounts through information sharing agreements with other countries. Many foreign financial institutions now report account information directly to the IRS under FATCA. If the IRS discovers your accounts before you voluntarily disclose them, your options become much more limited and expensive. Practical steps to ensure compliance. So, what should you actually do to make sure you're handling this correctly? First, make a complete inventory of all your financial accounts and assets outside the United States. This includes bank accounts, investment accounts, retirement accounts, life insurance policies with cash value, and any other financial assets. Don't leave anything out just because it seems small or insignificant. Write down where each account is located, the financial institution's name, the account number, and the maximum value during the year in US dollars. To convert foreign currency to US dollars for reporting purposes, you typically use the Treasury's Financial Management Service rate for the last day of the calendar year, or if no rate is available, another verifiable exchange rate. Keep records of which exchange rates you used and where you found them. Second, determine whether you meet the thresholds for FBAR or Form 1838 or both. Remember, FBR uses a $10,000 threshold for combined accounts at any time during the year, while Form 1838 has higher thresholds that depend on your filing status and where you live. You might need to file one, both, or neither, depending on your specific situation. Third, if you receive any income from foreign sources, whether it's bank interest, investment returns, rental income, pension distributions, or anything else, make sure you're reporting it on your tax return. This is separate from the account reporting. Even if an account doesn't meet the FBAR or Form 8938 thresholds, any income it generates still needs to be reported. Fourth, research whether your country has a tax treaty with the United States. Tax treaties can affect how foreign income is taxed and may provide credits or exclusions to prevent double taxation. However, you typically need to properly report the income and claim treaty benefits on specific forms. The treaty doesn't automatically apply just because it exists. Fifth, keep excellent records. Save statements showing your account balances throughout the year, especially the highest balance for FBAR purposes. Keep documentation of any foreign taxes you paid, which might be creditable against your U.S. tax liability. Maintain copies of all tax returns and foreign account reports you file. If you're pursuing citizenship, you may need to provide these records to USCIS. When to seek professional help? While I'm providing this information to help you understand these requirements, I want to be very clear about something. Foreign account reporting and international tax issues can be complex, and every person's situation is different. If you have significant foreign assets, multiple accounts in different countries, foreign pensions, or other complicated financial arrangements, or if you've realized you should have been filing but haven't been, it's worth consulting with a qualified professional. Look for a CPA, enrolled agent, or tax attorney who specifically has experience with international tax issues and foreign account reporting. Not all tax professionals are equally knowledgeable about these specialized requirements. Ask specifically about their experience with FBAR, Form 8938, and FATCA compliance. If you're dealing with past non-compliance, you want someone who has successfully helped clients through the streamlined filing procedures. The cost of professional help is almost always much less than the cost of penalties. And the peace of mind knowing everything is handled correctly is invaluable. This is especially true if you're in the process of applying for citizenship, where tax compliance can affect your immigration case. Addressing common misconceptions. Before we wrap up, let me address some common misconceptions I hear frequently. First, many people believe that if an account is in a foreign currency or in a foreign country, the IRS won't find out about it. This is increasingly untrue. The United States has entered into agreements with more than 100 countries for the exchange of tax information. Foreign banks are required to identify U.S. account holders and report their account information to the IRS. The walls between tax authorities in different countries are coming down, and the IRS has more information than ever before. Second, some people think that if they already paid tax on the money in another country, they don't need to report it to the US. The reporting requirement exists, regardless of whether you owe US tax. The US needs to know about foreign accounts to determine whether you're properly reporting foreign income and to combat money laundering and tax evasion. Third, people sometimes believe that only wealthy individuals with large offshore accounts need to worry about this. In reality, the $10,000 FBAR threshold is quite low. A modest savings account, especially in countries with strong currencies, can easily exceed this amount. You don't need to be wealthy to have reporting obligations. Fourth, there's a misconception that closing foreign accounts eliminates past reporting requirements. If you should have filed FBAR or Form 8938 in previous years but didn't, closing the accounts now doesn't make those past obligations go away. You may still need to address past non-compliance. Finally, some people think these rules only apply to accounts they personally own and control. In reality, you may have reporting obligations for accounts where you have signature authority, even if the funds aren't yours, or for accounts where you're a beneficiary or have some other financial interest, depending on the specific circumstances. The bigger picture, why these rules exist. It's worth understanding why the United States has these requirements, even though they're more extensive than what most countries require. The US government's position is that requiring citizens and residents to report foreign accounts helps combat tax evasion, money laundering, and the financing of terrorism. These are legitimate governmental concerns, even if the burden falls on honest taxpayers who have perfectly legitimate reasons for maintaining foreign accounts. The FBAR requirement dates back to the Bank Secrecy Act of 1970, while Form 8938 came about through FATCA in 2011 after concerns about U.S. taxpayers hiding money in offshore accounts to avoid taxes. The rules affect millions of honest immigrants and expatriate Americans who simply maintain normal banking relationships in their countries of origin or residence. While the requirements may feel burdensome, especially if you're juggling life in two countries or maintaining family connections across borders, compliance is ultimately about transparency and following the law. The good news is that once you understand the requirements and establish a system for tracking and reporting your foreign accounts, ongoing compliance becomes routine. I hope this comprehensive overview has helped you understand your foreign account reporting obligations clearly. These rules are not going away, and enforcement is only becoming stricter as information sharing between countries improves. The key takeaway is this: if you have any financial accounts, assets, or income outside the United States, take the time to determine whether you have reporting obligations. And if you do, make sure you're fulfilling them completely and accurately. Remember, the vast majority of people with foreign accounts are not trying to hide anything. They're immigrants maintaining connections to their home countries, Americans who worked abroad and kept accounts there, or families with international ties. There's nothing wrong with having foreign accounts. The requirement is simply to report them properly. By understanding these rules and taking them seriously, you protect yourself from penalties. You ensure smooth processing if you're applying for citizenship or other immigration benefits, and you have peace of mind knowing your tax affairs are in order. If you found this video helpful, please give it a thumbs up and share it with anyone you know who might benefit from this information. There are millions of people in the United States who have foreign account reporting obligations but don't know it. By sharing accurate information, we can help people avoid unnecessary problems and penalties. Don't forget to subscribe to Move to USA and hit the bell icon so you're notified whenever I post new content about immigration, taxes, and other topics that affect your life in the United States. I'm committed to providing you with accurate, helpful information you can actually use. If you have questions about your specific situation, drop them in the comments below. While I can't provide personal tax or legal advice in the comments, your questions help me understand what topics to cover in future videos, and often other viewers have the same questions you do. As always, please remember that everything I've shared in this video is for general informational purposes only. It's not personal tax or legal advice. Every individual situation is unique, and tax laws can be complex and subject to change. For specific guidance about your circumstances, please consult with a qualified tax professional or attorney who can review your particular situation and provide advice tailored to your needs. Thank you so much for watching. I'm here to help you navigate the complex intersection of U.S. immigration and tax requirements with clear, accurate information. Stay informed, stay compliant, and I'll see you in the next video. Take care, and remember, knowledge is power when it comes to protecting your future in the United States.